And it's Markets with May, and today we are going to talk about Upstart. It's one that I have been posting on, and people get very fired up about Upstart. I'm really shocked at how fired up people get, even relative to AMC. But Upstart reported their quarter last night and it wasn't good. The stock is trading down slightly. It was down a lot more earlier. But I want to go through the numbers because it wasn't a good quarter. And I swear this company has nicer investors than any bank I've ever met. Ever. They even have nicer investors than the asset managers do because not a person asked the questions that actually mattered at all in any way, shape, or form. They just keep pretending like this company is actually a mortgage originator, even though it's got over $1 billion in loans on its balance sheet, and it doesn't really have any meaningful way to get those loans off. So let me go through what happened in the quarter. I do have positions in this. I will say I actually have, gosh, I don't even know if you could if you say it this way correctly. I have some calendar spreads. Yeah, they're mostly calendar spreads. They may so a couple are diagonals, but I have calendar spreads fairly wide around where it's currently trading. And because I took most of my profits yesterday, thinking that for whatever reason, this market potentially wanted to bid it up when it was down a little bit more than I would have anticipated ahead of earnings. But quite frankly, if you pushed me, do I think this company is a long? Heck no, it's not doing the things that it needs to do for me to ever assess any kind of meaningful valuation on it. And I'm going to show you precisely what they're reporting. And then I'm going to talk about what they actually need to report, given what their business model is and will be for a minimum of 6 months. So let's take a look at it. Okay, let's see. 1 second, share. All right. Here's the biggest problem right here. Okay, I wanted to write this out so that I wouldn't say it wrong and it wouldn't be any confusion. Are you a loan originator or are you a loan asset manager that focuses on, in both cases, underserved markets? Because you keep saying or suggesting that you're now writing more prime loans, but you have not produced metrics that would allow any of us to see that. Additionally, in both cases, even though you're holding more than, now you're holding $1 billion is what you're saying, but I think that's actually a little bit of a cheat, quite frankly, and I'll show you why. But you're holding about $1 billion in loans. Now you're admitting to it, and about half of that is auto loans, and you're telling me that it's what? Is it subprime or is it prime? Because it's very different, and we're going to go through why that is the case because it's a real potential problem. I don't know that. Well, we'll go to what you should do next with the stock. But here's what the revenue is. Revenue down 7%. Operating income and EPS was a big fat L. EBITDA is like barely, or, if you do like free cash flow, you're just skating right there. And I'll show you how much they pulled out of cash in just a second. Let me see if I can actually increase this so you can see it better. But you'll see that most of look, here's the thing. Revenue from fees, which is what it would mean to be an originator, is 155 million. Total interest income and fair value adjustments, you're saying is just an L of 8, right? So you got interest income of 39. Your fair value adjustment is 43. So you took an L on that interest expense. My issue is, and let me just be really clear, is what is that? Like what kind of fair value mark did you take? My guess is they took what most loan books take if they're not officially an asset manager, which is just that's a credit loss, not a mark to market loss on the actual loans. Because in order for you to tell me or explain to me what the mark to market loss would be, you would show me that data, and there's no show me of it whatsoever, even though you've taken now you're $1 billion loan book. Additionally, if that loss was the only loss, if that was actually truly a mark to market loss on the face value of the loans, you would sell the loans out instead of keeping so many on balance sheet. I mean, that's like classic what's happened in every interest rate cycle. So to me, you telling me and mouthing me the words that the loans are actually performing better because your AI model is awesome is like not really helpful because everybody has been showing lower loan losses because of this particular cycle. We're still seeing employment rates very high. And so, yes, however, guess what the other companies do? They take the mark to market loss. Like Goldman Sachs takes the mark to market loss on repricing the loans. Here, I can't tell what this is, but this sure doesn't look like a mark to market loss. And I'll show you why very clearly by using the CPI numbers as a proxy. Okay, next. Here is the increase in loans. This is how most people do their balance sheet, so I can't get mad at you for this, but quite frankly, it's not clearly shown if you just look at balance sheet. So you can see here cash has been halved year over year. So now they've got 422. And that's the real reason why revenues are declining, which I talked about. Once you continue to grow the size of the book, either you're going to become a bank and sign up for a charter, which totally changes your business model. And by the way, as much as people want to say banks make a lot of money, kind of, but you're going to have to take your mark as soon as you do that, because the banks have this concept of tier 1, tier 2 capital, and they're not going to let you pretend like those things are just on the books at a beautiful price because they're performing loans. You're going to have to take it associated with the credit ratings they have. Additionally, you're going to have to share with us what those credit ratings are. So there's that. But as this number of cash draws down, as this number of cash continues to draw down, we get closer and closer to what that is the deal. Okay, so loans at fair value is $1 billion now. Loans in fair value in the third quarter was 700 million. So it's about 300 million increase. If you'll look every single quarter, this has been increasing faster and faster. I think it was like 200 something million last quarter. Now it's 300 million. That's despite the fact that they're issuing and originating less loans, because guess what? That's the right call if you can't get these things off balance sheet, unless your goal is to become a bank. And then the borrowings number is about the same, but I want to show you why I think there's a potential understatement here, and that's from the cash flow statement. If you look at this is proceeds. There's these two things: purchases of loans held for sale, proceeds from loans held to sale. You can see that typically, what you look for, and what I always look for something that is not a bank, but we're in this like strange economic time, is this. Where might you be hiding certain loans? This is it right here. This is $1 billion higher. And if they cannot sell those, if the loans are not being sold out properly, they're going to eat some portion of that in order to move on. So that's not great. Now, that is really the majority of what they gave. I want to show you something really important. This is CPI, our Valentine's Day CPI report that came out yesterday. And I want to show you that you can kind of see this was the number that was posted on the month. This is a year over year decline. So this is the annual number. And used trucks year over year continue to post a very negative number. So from December to January, you still saw a decline in used prices of 1.6. So far for the year, it's down 11.6. Now, why is this relevant? This is relevant because they have only been an auto lender since 2000. So like tail end of 2000, according to their 10K. So these loans, and especially if you look at when the loans started to increase on their loan book, you started in the second quarter. So since the second quarter, these loans that they haven't been able to get off, which means really the first quarter, those loans are getting older and older. This is the actual loss. Okay, so this would go into how you should mark your book. This would be because what happens for auto market is not the same as personal loan market. When you have an auto loan, one of the things that will force an event, a default event, right, is if you get into a car accident and the insurance company then they don't pay off the loan, they pay off whatever the car is valued at. So these precipitously falling used car prices are not insignificant. Additionally, auto loan, the thing with the way that any AI is going to go and do this stuff, right? It's going to go and it's going to be like, okay, what's the historic rate of auto accidents that happen like that, right? And because of work from home, there was far less miles driven. And so now we're starting to normalize back into normal auto loan type stuff, for lack of a better way to describe it. Now, the last thing that I would mention is I highlighted as well the price for parts. And you can see the price for parts is up huge. So we've got used car prices down almost 12%. And then to fix the car, just the parts side of it is up 10%. So that's excluding the services portion, which is up even more because like this is not exactly incorporating the cost of actually fixing up the car, right? So given that, when your insurance company goes to pay out, they probably will decide to just pay out the car, not necessarily your loan, which may be more. And then you're going to get less resale value on your car after fixed up or not. And you're going to have to deal with it that way. And that's the piece that then goes into the two parts of how you would actually mark a book of loans. And let me show you the two little baby vocabulary words that you need to know, which is, these are two little baby, it's hazard rate and recovery rate. Okay. This is the two important parts of how you would actually price a book of loans that I'm specifically talking to today. I mean, there's other stuff too. Don't get me wrong. I'm not saying this is the end all be all, but the hazard rate and the recovery rate have changed notably since these loans were first written a year ago. Okay. So that is my bugbear with this company. And that's why I believe that they are keeping more of the loans on balance sheet. They said in their question and answer session that it was because they've just decided to keep more of these loans on. But that sounds like when a guy breaks up with you and you're like, no, well, I decided to break up with him. Okay. Like we all know that's a little bit BS. That makes you feel better. That makes us feel better as the investors. That's fine, but it's not true. Okay. So that's what I think is happening at Upstart. Now, do I think that it's over undervalued? Why am I saying it's a hold versus a short? And it just has to do with book value. Book value is how you would assess an asset manager, and they are trading about 1.5 times book value. Now, can they trade below book value? Yeah, they can. It's just that if you believe someone would purchase their interface relationships and the AI model at a certain number, then that's what the other part of the book is valued at. Do I think that the book of loans is overstated, and that if they had to do a breakup valuation, that it would be under 1 times book value? For sure. Like, not just for sure, just to give you a sense for it. If most of that book is subprime, then the appropriate marks that you might take on a loan is like, you might mark it at 30% of the loan value, because that's how subprime rolls in specifically auto. But I think that's aggressive. 10% easily is a haircut. But even then, as an asset manager, you wouldn't trade at 10% of book value, like 90% of book value. I mean, just go have a look at like your comparables, which would be something like an Invesco, et cetera. That's a really seasoned company, and that has permanent capital. This isn't permanent capital. So let's actually stop for a second. There are a couple of other little notes I just want to say that they would need to give if they're going to be appropriately discussing what's going on with investors. The first thing is, what is the actual elements of this book? Like, what's the duration of the loan book? How old are these loans? Auto loans are typically about 5 years old. What did you write? Are you writing 7-year loans that are even beyond the depreciation of a car? What's exactly going on here? What's the average credit rating of the loan? We don't have that. We have them mouthing us that they have the best, 5 vintage situation of all time, but we don't have what is just the average, the stuff that you kept on balance sheet. Do you have to keep all the subprime? What's going on there? They said a little bit like it leans more towards prime, but I just like, this should just be a number. This shouldn't be like, I'm kind of giving you like rough guidance, and then I'm not really telling you which portion is, when I say it's like mostly prime, I'm not telling you whether it's the business loan side or whatever. That's nonsense. Okay, what precisely was that mark that we saw that you took on your income statement? I need that, because otherwise I'm pretty sure that I'm right. You're not taking loans on the principal value of those, such that that's why you're holding the loans, not because you're just waiting for the market to open up. You just don't want to take it on your balance sheet. What is the loan loss versus, okay, they say in every call that their loan rates are better than a comparable model. Well, it turns out the banks are actually showing really decent loss ratios. So what are yours in comparison? That's all I really want. I want the actual, what are the banks, or just give me your loan losses. You know what I mean? And then I could do my own work and compare it across all the other regional banks that are also showing very low loan losses. And then, they talked about the fact that they were very close to deals with more lenders, but that even with, they need to actually negotiate that once they say that they would give the loan at this rate, that they actually then give the loan at that rate, which is what's happening is the lenders are like, yeah, I would give you a loan at this rate given this credit score. And then the bank's like, yo, dude, we have enough auto loans. We're not giving it out. And then that's what happens is that they end up eating the loan. And then it's just the mark to market risk associated with the fact that we have this crazy interest rate environment that's going on. So those would be the things that I would need in order to actually do any kind of meaningful valuation on this and really understand what would be the actual book value of the lending portion. The final thing I'm going to say that makes it a hold and potentially even a short, quite frankly, if it runs up too much, you really can't let it run up that much, is that until they get these loans off the book, they got two choices. Or until they get a massive funding source, not a small funding, trickle it in funding source, but a massive funding source. It's going to put pressure. They can't write, like everybody kept trying to pretend like, oh, in this kind of environment, do you get to be more competitive? Guys, this isn't a retail business. You do not want to be more competitive on your pricing in loans, because essentially what that means is that you're writing loans that no one else wants to write at that rate. Okay. That does not make you competitive. That makes you stupid, with all due respect. So they definitely answered this question correctly, which is we are dialing back until we see more demand for the loans itself. But like, that's why I was like, this is the nicest group of investors I've ever seen, because if this was actually a group of finance folks instead of what looks like a bunch of tech folks, then I would be like, what kind of question is that? Like, you know what I mean? It was the crazy thing. Okay, so now I'm going to go to the chat and see what I have. Hey, Israel, good morning to you. You know, it's funny. I love the Ford F-150. What does that mean? I see. Okay. So look, here's the thing. My dad actually bought an F-150 as well. I think it was an F-150. It was between two cars. We were trying to fix up and stuff. Okay. The CPI on the truck data, trucks are a little bit of a different animal versus cars, but in both cases, the dynamic are a little bit similar. Okay. So in general, at 7 years, a car is fully depreciated at that point. So, but with trucks, a lot of times you still have buyers on the truck because you use them for work. Now, oddly enough, because of the rise of Uber, you also have certain residual values that support cars that specifically would be used for Uber or for Turo, which is, EV cars, hybrids, things like that, stuff that gets really good gas mileage. But oddly enough, the dynamic for trucks is ever so slightly differently. Now, that said, if you have that aggressive of a CPI number, then everything backs off. But I want to show that CPI number one more time, because sometimes I do go through the numbers in their entirety. But this one is actually kind of an intriguing scenario that we've got on CPI. And that is that the new car number is not declining in the same way. This is a dynamic that I talked a little bit about before, and it's part of the reason why I can still be very bullish on Tesla with a straight face, not lying to any of you. Because if you look at new trucks and new cars, those numbers are going up, and that's 100% related to the fact that the gas mileage is better. Okay. And gas mileage being better is really what's driving some of the overall dynamic that's happened. Now, the other companies that this dynamic is very poor for, Carvana, which I've come out neutral on to like slightly positive when it was at $5. And now it's at 10. And I got to admit, I've got puts on Carvana every now and then as well, although I'm scared a little bit because it will pop a little bit if that guy gets his funding. He's got about... I see everybody else was calculating his shortfall at like 150 million. I'm like, no, he really needs to get closer to 200 million on the immediate to just stop the losses. And then he's got to probably do a little bit better than that. I also will say that part of the reason this number on used cars is almost 12% is because Carvana and CarMax are both liquidating cars right now, or have announced liquidating cars. Now, that said, they are not so large in the market. There's 400, I think there's like 45,000 dealerships out there, of which the top 100 dealerships are still like very small percentage of the total market. But that said, probably all of the seasoned auto folks are thinking about the same way, which is get rid of as many used cars as possible, because some of the smaller dealerships are going to either go out of business or people are going to decide to retire. And then so used cars are going to come up for really cheap. I'd rather have cash. So that's what's going on. Okay, what is a prime lender? Oh, so glad you asked. Okay, so prime lenders. So all lenders are just lenders, but most banks. So what you want to think about is it's credit score related. So typically you're going to be looking for a very high credit score, meaning like over 650. I would say probably over 700 these days is what they're talking about with prime. But there are specific cutoff points, and there's no real like all of the broker dealers will do both prime, subprime, and what I guess is now being called super prime, and that's the right way to call it. But because interest rates have risen so much, and for a Morgan Stanley or a big broker dealer, they're going to be trying to make as much money as they can. So they're really going to be going across the entire spectrum, and wherever they can find a good price on a loan, they'll just buy the loans, because they'll be like, okay, given the default rate, given all these calculations, I think that this is really great. And just to give you a sense for it, in subprime auto, there are usury laws, right? Meaning that the max you could charge someone is a 30% interest rate, 20% interest rate if they're a subprime, someone with a low interest rate, but they need a car. And there are actually auto lenders that did not issue loans so much last year because of the increase in used car prices, but are issuing loans right at that usury rate, because they know that this dynamic that I just talked about as relates to hazard rate and all that other stuff is for reals. But that doesn't sound like what Upstart is doing. Upstart is using AI to price great loans. So of course they can write as many loans as they want. The only thing is whether or not the bank's going to take them. Now, so that's in the subprime market, you've got folks that will strategically take loans where they can get outsized returns because of where those types of loans sit on the balance sheet and how the actual banking regulators are going to make you mark that loan. Okay. So they're an originator. They're not a bank. So they don't have to mark those loans. That's the whole deal. Now, if you're a bank, it depends on which strategy you're taking, but most banks are taking the strategy of, I'm a bank. I don't necessarily need to swing for the fences. And if I can get this huge interest rate just off of a very good credit quality, I'd rather do that than dip down into subprime land. So great question. Sorry, it's such a long answer, but that's what it would be. Seems like cars would be going up in value with the chip shortage. Okay, so that was the case last year. This year, some of that has alleviated, but even then, the cars don't go up in value. The cost to repair cars goes up in value. The new car market, that is going up in value, and that's what CPI is showing. That's the logic there. Let me just see. What is this question? Okay, this is AMC. I'm not sure if I'm prepared to answer this. I'm an AMC veteran. It seems like there is always someone getting into the company buying 20 million shares at a time. Okay, I don't know the answer to that. I don't know the answer to that. I'll tell you what, though. I do have Friday a guest coming on. We're just going to talk about media stocks in general. We may talk a little bit about AMC, but you guys got to let him talk about the rest of the media space as well, because he's really great. So preview on Friday after the close at 4 p.m. And then let's see. Israel's really chatty. I'm so glad you're up this morning. Located when it doesn't seem like anyone is selling. Okay. Where are those 20 million shares located? Okay. That is a longer story, because I do think that I probably do need to do something on short selling, because there's a lot of crazy stuff that, like, what is actually the process when you go to find a locate, et cetera. But yeah, there's a couple different ways you could do it. If you just wanted exposure because you're an ETF, you could do it via swap, which means you're just basically swapping that exposure. So you don't, though, if you're doing it via swap, you don't actually own shares, so you would not have a vote or anything like that. If you're buying stock, right? If you're selling stock, It's a little bit of a different story, but I think that the fluctuation is probably coming from any number of weirdness that is related to reg show and the fact that there's 5 days where you're allowed to do that. All right. I am probably Israel. You're so sweet for like coming on here and like giving a bunch of heads up. HR33. I'm not sure what your question is related to this on GM. I do have a video out on GM and Ford, and you know I love Tesla for various reasons. But I'm going to go ahead and close it out because I got to get some prepared for the trading day a little bit. Hopefully this is helpful for those folks in follow up. I think it's a hold, but if it tries to rally today, this was not the quarter to allow it to rally. So you just kind of have to think about, you know, like I'll probably, if it rallies too much, I'll probably let it settle and then find a place to short it again. And I may even just find a place to short it just because I don't think this was a good quarter. All right. Bye guys. Have an awesome morning.